Well, hello, everybody. Welcome to another edition of Beyond the Bank. My name is Andrew Auerbach. I'm really looking forward to the discussion today with Colin. I've been enjoying following Colin's progress with the launch of his firm. And as you will see in this discussion, we share a worldview on the opportunities to do things differently in Canada. So let me tell you a little bit about Colin, and then we'll just jump right into the conversation. Colin White has been working to transform the financial services industry since 1992. A graduate of St. Mary's University with a BCom in accounting, Colin is a chartered professional accountant, a certified financial planner, a chartered investment manager. Colin is co-founder of Verican, a company purpose-built to eliminate the conflicts of interest that are rife in the financial services industry. Through a new firm, Verican is quickly becoming known for its honesty, authenticity, client-centric approach, and setting a new standard in financial advice. With 8 locations and more than 40 employees, Colin and the integrity-driven team at Verican offer the combined powers of credentials, experience, and perspective to help clients achieve their financial goals. Colin, welcome. Thank you for joining us.
Well, thanks for inviting me, Andrew, and that's a very kind introduction. I appreciate all the kind words.
Well, they are deserved. I mean, one thing that I have been trying to highlight is the opportunity for different approaches in our industry, and for the fact that there's not one bad approach or good approach. We're a highly regulated place, but different approaches are good ultimately for clients, and they're good for the industry because it brings everybody higher. And my observation is that's been kind of your passion as I watch you launching Verican.
Well, absolutely. I mean, over the years, I've been exposed to a lot of really good people doing really good work in the industry. But again, my observation has always been it's in spite of their environment, not because of it. And, the environment that is pervasive here in Canada is not supportive, as it could be, towards providing the kind of financial advice that Canadians deserve or should expect. But, there's a very large status quo, and it's very, very difficult to be the spark that ignites the flame and try to make a change. So, similar to your guys' your position or path as far as, learning from what happened in the U.S. with the RIA structure, depending on the list 20 to 25 years ago. I mean, there is a path to revolutionize things a little bit. And, this is a bit of a social experiment. Put together a group of really talented, dedicated people, and we give them to do good things, and we think that's a good business model. I'll let you know, month by month, year by year, how the social experiment's going, but so far, so good.
Amazing. Maybe a good place to start, Colin, is if you could set folks up on your journey. What has been your career path that brought you ultimately to Verican? And I think that will inform the broader conversation we're going to have.
Well, sure. I mean, I started, as you indicated, I came out of school as an accountant. I went to work for a fish company here in Nova Scotia. And fishing times weren't good, and unemployment was high. I started my family by quitting my job as an accountant to go sell life insurance for Standard Life back in 1992. Now, I knew that wasn't what I wanted to do, but there was something there that intrigued me. So I went on a bit of a journey to kind of, see what was going on in the industry and try to learn from it. So that was back before there was an internet. So I was a financial advisor before there was an internet and before there were cell phones and all that stuff. So it's been quite the journey. So I kind of wandered around in the wilderness probably until 2008, 2009, 2010-ish, where I kind of drew the conclusion, I don't think I can do it on my own. What needs to be done for the average consumer? I just can't. I'm an arrogant man, I really am, but there's no way to really deliver on what should be done. So I started building a team. So talked with some very, very high quality people. We began building our team called 2010, 2011 with a very similar mindset. And it's just gained momentum and attracted attention. We started with a small local dealership here in Halifax, and then moved to Dundee Securities back in the day, and then went through the tumult of being purchased by Scotiabank, and then being purchased by IA Private Wealth, which taught us a lot of things. And the group continued to grow through all those iterations. The whole group of us was what decided we were going to do Verican. So we went through that journey to launch the Verican company and move away from that more standard or more traditional way of doing business.
And why, when you talk about perhaps, before we jump into conflicts, the idea of doing what you want to do for clients within a corporate structure. You've been through, it sounds like 3 of them, vis-a-vis how you've gone. What are the pros and cons? In other words, what are the things that actually are supportive that I think the mainstream, or to your point, the fact that, we are pretty entrenched in terms of how concentrated our market is, and then some of the trade-offs, in terms of what you're experiencing at Verican now that you're fully independent?
Well, I'm not going to soft sell. I mean, being your own thing comes with a lot of additional skills you got to pick up. Yeah, it's way more complicated being your own thing. So there's a simplicity or a comfort in joining something that's more standard. You can look around the room, there's 20 or 30 or 50 or 500 people doing the same thing. Okay, I don't have to be too inventive here. There's a proven way forward. There's a proven way to make this work, air quotes. So it's certainly more comfortable from feeling comfortable, you know what you're doing. Many advisors call themselves entrepreneurs or in business for themselves. But if you're operating underneath another logo, which has, you're being given all your systems to use, there is a tremendous amount, and you guys have gone through this, there's a tremendous amount to learn in putting together all those systems. There's the presence in the brand recognition community, so a lot of the bigger brands are recognized. I mean, it's difficult to walk into somebody with a brand new company name and have that trusted. So there's systems in place, there's a proven way of doing things, there's some brand recognition. Will be the losses. The negatives come into conflicts. Now, that the 2 purchases that we went through working for Scotiabank and working with II Private Wealth, again, we were able to do good things, but it wasn't because of what we were, because the conversations with management is, okay, we need more product being sold. We need different product being sold. How can we incentivize using internal product? And that's fine. I'll ignore that conversation. There's a lot of conversations to ignore. The energy being wasted on things that just weren't productive. And it was frustrating. You're sitting down and saying, listen, I got this idea on how we can serve our clients better and turn this to a service industry. And they said, that's nice, but we want to talk about how we're going to cross sessions. You can only walk out of the room so many times. And after a while, it's like, if I've got a partner I'm not talking to, it's a bad relationship. That eventually is what drove us to move to the Verican thing. And that was, again, over time, building up the group of people that we all looked around the table and said, yeah, we have enough to do this. We have enough experience around the table. We have all the skill sets we need. And we have the commitment to doing it because we were jumping into doing something we can't do.
Okay, I really like the way you positioned some of those conflicts that exist where your purpose is not necessarily in alignment with the corporate purpose. And it doesn't mean the corporate purpose is wrong. It doesn't mean it's unethical. Of course, these companies operate with a high degree of integrity and sales practices and all of those things. It's just the notion of us trying to do work as a fiduciary, which basically means you work for your client. Everything you're doing is in interest of your client, and the parent, their interest is maximizing profit for the shareholders. And sometimes those 2 things don't intersect. And sometimes it means it's creating a bit of a buffet that you're not looking for. You're not actually interested in the buffet as you've been just describing. So,
yeah. Well, no, that was every conversation we had when we were working with Scotiabank. Like literally every conversation ended with, well, what's in that for the shareholder? Like this month, like they weren't willing to spend any kind of money that wasn't going to have an immediate payback. So the idea of investing in something that was going to grow the business over a year or 2 was completely foreign, and that's frustrating because that kind of the short-sightedness really impacts what you can do. That really got to be frustrating. And then when I Private Wealth purchased us, I know it was for the explicit purpose of that conflict between manufacturing and distribution. I Private Wealth owned Verican mutual funds, and they were not getting penetration of the funds into their distribution. And they really liked, because back in the Dundee days, 55 to 60% of the assets were actually held with dynamic mutual funds. So the distribution arm was heavily supporting the manufacturer. And from a shareholder perspective of Private Wealth, then yes, we want some of that. So they brought this distribution force in and said, we just need to recalibrate this distribution, and we're going to see the same success on the mutual fund side, which again, did nothing for the end consumer except introduce a different concept. It was just, it's one of those things that you can sit in the room and ignore it, but I'm sitting in the room wasting my time getting frustrated, and I get angry, so it was hard on me.
I think this is a really important point that my experience with clients is they don't fully appreciate this conflict of having the manufacturer in the same place as the distributor, even though from a regulatory point of view, of course, you have, I have, every advisor has requirements around what products are selected for their clients. It's a distraction that's unnecessary in a fiduciary context when we have access to the world's greatest products. In other words, I have no doubt the manufactured product is good, but we can access probably a better product by virtue of being able to access thousands of potential options.
Well, look, the thing was, I'm in the middle of a cross-Canada tour talking about conflicts of interest. And there's a few different points. People don't understand what manufacturing and distribution in the investment world. The whole concept that things get manufactured and then they get distributed. I was amazed at the number of people, and again, I think you and I and our parents would be very, very comfortable with that. But you said that to the public. You said, I'm talking to some accountants, and they go, I never thought of it that way.
Yes.
You never thought of it that way? Like that's new to you? And it introduces a tough challenge because the industry went through something. I spent 4 years on the National Advisory Council for Auerbach, and I participated in the industry. And I was there when the conversation started around know your product. Because there's a real problem that the investors brought forward that they were being put into investments that really weren't well understood by the advisor that was providing them. Well, that's a real problem. Okay, what are we going to do? Let's hold some meetings. Let's have some conversations. All right, so we're going to introduce this know your product. There's a new requirement now. Advisor placing a product needs to know the product. This is a good rule. Yes, absolutely. We solved this problem. Wonderful. Well, then all of a sudden, a bunch of institutions said, well, we don't know all these other products, so we're only going to have our own products on the shelf now. So you had a regulator trying to do something good based on good feedback from consumers, but when it got to industry, all of a sudden industry used it. And you can either say maliciously or just conveniently said, okay, we don't want to go through all the work of understanding the third-party product, and they dramatically shrunk their shelves, which wasn't the intended outcome. And that's now a problem. It's a known problem, and they're trying to figure out what do we do about it, because that's not in the best interest.
It's the opposite outcome of what the regulator was hoping for.
But you can see how everybody in that room was trying to do the right thing. Yes. I mean, this is where I'm not sitting here saying there's some really easy solutions to this, because there's some really solid people trying to do some solid things, and they're just missing. It's like, oh, that's wonderful, great shot. Listen, can you take another shot at this because you didn't quite get it? And sometimes it's we're late getting to the ballgame, right? There's that class action lawsuits being settled against major providers over allowing mutual funds to pay a trailing commission into discount accounts.
Sure.
Well, many of us in the industry saw that as a problem when it was going on. It persisted for a while, and now they're writing checks. So it was a bit of a lag in some of these things, and it's difficult to navigate as long as you have the manufacturing and the distribution so closely tied. There's going to be those kinds of things.
Yeah, I think the best illustrator of what you've articulated so well here is the MERs for mutual funds. In the area of clients in, let's say, the mass affluent category that are going into bank branches, not necessarily the clients that we're dealing with. These are the clients that I think end up paying the biggest price, because the lack of competition around how you're describing in-house product creates MERs that are now 2 times greater than what's happened in the US. And so I saw recently, as you did, the most recent IFIC study saying it was about 140 basis points was the average active MER. And in the US, it's under 70 basis points. And there's a problem with that, and it's a problem that, to your point, is going slowly to resolve, but ultimately will be resolved, I would think.
Well, I mean, we have to understand we're 10% of the size, or even less than that, of the US when you talk in financial terms. So we're not going to be as efficient for sure. But the close tie in Canada between manufacturing and distribution does bleed into that. And the other thing I'm watching happen in the mass affluent, or the high net worth and high net worth space, is all of the new products that are coming out from the private debt, private equity side, which are more opaque, and they're being that's where all the manufacturing is. And the opacity in them to actually understand them. When we're doing our due diligence on the out of effort, we have to put in, understand everything that's in there, and then you start detailing all of the conflicts that are inherent in the product. And say, holy cow. Because in my experience, if something is not clear, anything that's opaque, that benefits the manufacturer, not the investor. And that comes from being in the industry a long, long time. So yeah, that's absolutely, again, that manufacturing is happening. And the distributors are taking a piece of that manufacturing, profit margin, whatever it is. And once again, this creates that conflict.
Yeah, the complexity of some of the products and this notion that it's kind of, the product du jour, that everybody wants alternatives. And of course, in the private client space, there's a real lack of understanding of how these vehicles work. And I often hear public markets talked about negatively in a critical way, as opposed to turning that around to what do you get with public markets, right? What you get is arguably a whole lot of market efficiency, transparency, to your point, a whole lot less opaque than how some of these alternative vehicles work.
But it goes to the motivation for manufacturing a product. Like the product's going to go to market if it's sellable. It doesn't have to be a good investment idea. I mean, I went across Canada when marijuana became legal, and I made fun of it, like all across Canada. Now, I could have gone across Canada and gathered millions of dollars in assets by promoting it because people really wanted to invest in it because it was a new thing. But our research indicated that it was not an investment opportunity. There was nothing there. But were there products out there that would sell you marijuana? Absolutely. And we're going through that right now with Bitcoin. In our opinion on Bitcoin, it's the world's largest Ponzi scheme, and it's likely to persist for a while, but it's not an investable opportunity. But the SEC has just approved an ETF in the U.S., which has made it more available, which is helping the values of the various cryptocurrencies. So, because people want to buy it, it's going to get manufactured. That doesn't make it a good idea, right? That the industry, the financial general, will pander to that. What's sellable right now? What do people want to buy? What can we generate that people will actually purchase?
It is amazing how history repeats as it relates to some of these cycles. But to your point, the benefit of being able to have experience in some of these markets and look at what happened, because we're in a business of tails. It's kind of easy 80% of the time, and that other 20% is really what defines an investor's success. And things like alternatives, I have no doubt are well placed for many, many clients. And I also have no doubt there's many places where they are not well placed for clients because of the lack of understanding of those tail events. That what liquidity actually means is not a question when you don't require liquidity or when liquidity is not available in the investment.
Well, the most recent example I point to people, if I came to somebody in January of 2020 and saying, look, I've got this commercial real estate investment here that yields 6.4%. Commercial real estate's as solid as it gets. Commercial tenants always pay their rent. This is just like a bond. And then March of 2020, the world shuts down and everybody goes home, right? Now, that was a great theory, but by being overconfident in it, I made my investment portfolio unnecessarily fragile. And the upside was not nearly enough, I would say, for a tail event, as you described. But again, people like those stories, and people, it's very easy. I watched a podcast with Richard Thaler, who was the Nobel Prize-winning economist, and he made the comment it's way easy to take advantage of people's weaknesses rather than try to correct them. That is the path of least resistance. It can be very good business. It takes extra work to try to protect people from some of their instincts, for sure, which is why there's going to be room for people like us.
Absolutely. And I want to talk more about conflicts. There's a couple of other areas I know you're very passionate about, but as a quick, let's just take a slight detour. One thing I've noticed about Verican is you're very good storytellers. As you describe your market environment, as you provide your commentaries, your team does a very nice job of making things quite explainable. Can you talk to us a little bit about that, the importance of making things relatable in our business?
Well, we've been able to change the narrative a little bit and talk purely from an educational perspective. And you throw that switch and you start from that room, all of a sudden your story hits different. Because the goal in doing all of our commentaries is to try to educate people and say, here's the big story today. Here's why I think it's important, but it really isn't. And the art of telling a story is something better over time if we study it. But we're aiming in a different direction. See, with Verican, we have a fundamental difference in what we are, that it's demonstrable and interactions in structure. So we can talk about that. We were laughing at one, but there was an advisor recently, some of the promo video came across our feed. We're taking a look at. He just launched the whole thing. But it had pictures of him in the gym lifting weights, talking about going to war and this, that, and the other, going, holy cow. Because in the traditional environment, if you're sitting in a traditional financial environment, it's homogeneous. It's very difficult to stand out. So what you're told is, use your personality. Use a drone to take pictures of you and your family walking on a boardwalk through the forest, and you're pumping iron in the gym to try to stand out to the public because, again, all the other stuff that you're talking about is so homogeneous. What else is out there? Well, we've taken a different tack. We're going to try to educate people. So therefore, our message can stand out. And it does lend itself to storytelling. Like, we hear all the time people talking about you need to invest like Warren Buffett. Well, stop. You don't need to train like Sidney Crosby. If I gave you Sidney Crosby's workout routine, you just go in the gym and hurt yourself. So there's so much that's easily lampoonable with the regular messaging that's out there. It really lends its blow up a little bit. For education purposes, we're trying to disavow people the idea that, an 80-year-old widow Riff should be investing like Warren Buffett. Or even a 50-year-old who's going into retirement should be investing like Colin Buffett. That's just preposterous to us. And that point of view stands out. That point of view is a bit more interesting. It doesn't get lost as much in the show.
I think the advantage you're highlighting as well, Colin, about being independent is you don't have the layers of bureaucracy, as you were describing, when there's 100 different ways of doing things. And of course, the firm needs to be very careful about what is being said, about the impact to the brand, etc. And so I think about some of the things you and I are doing now, like this podcast. I joke that in my prior roles, this would have taken months to get one episode produced. By the time the number of people looked at what we were saying, and then probably it would be the next presidential election cycle as opposed to this one that you probably want to bank the podcast for.
Well, yeah, I can clearly because we've always tried to be out there, so all of our clients and prospects are seeing us all the time. So we've always tried to produce a lot of content over the years. And at one point, I was told I couldn't use the word Trump in any context. And listen, I know the state of politics, and that's the third rail; you don't touch it.
Sure.
But to not use the name, like really, this is the room we've gotten to. Like, I'm going to sound like an idiot. I'm going to sound like a gibbering idiot trying to talk about current events without even being able to use the name. Uh-huh. I get it. The firm at the time had people really go pro or anti and cause all kinds of static. And I get that. That's absolutely terrible. But again, they took it too far. And you're right. Everything takes way long.
So that takes me to an area that I know both of us can get animated on, and it's the compensation practices within our industry. So as we talk about conflicts around product design, there's also a lot of conflicts around how people get paid. This notion of a commission grid and a very complex formula that could be 20, 25, 30 pages long for how you get paid based on the attractiveness of the product that is ultimately sold to the client. And I want to amplify what you said earlier, Colin. There's some phenomenal advisors operating as true fiduciaries for clients. They're just operating in an environment that can make it more challenging for them. I know this is an area that is definitely a differentiator for you. So just give me your feeling of how that gets in the way and sort of how you structured it at Verican.
Well, it's just funny because we've hired those people. Like, we found people who still had a soul. I mean, that's really the thing. Do you still have a soul? If you do, hey, maybe you can go work with us. So, there's one common story. I've heard it 3 times now. People who either already hired or people were about to. So standard bank branch sitting there with, they're assigned 600 clients. They have to hold 20 meetings a week, make 20 phone calls. They're responsible for all of their own admin work. If they hold 19 meetings, they have to put 25 phone calls in. Called every Monday by their manager to review the numbers. And their compensation is based on new assets brought in.
Yeah.
Go serve the public. And these people come to work for us, and they're going, oh my God, I can actually do a plan for somebody. Spend more than minutes with it. And I'm not going to get that phone call Monday questioning why I spend the time on something. But that's just setting somebody up to fit. I mean, again, the presentation that I'm going across, the way I describe it, the parable I used to describe it, is that a conflict of interest is something we all deal with. You're standing outside of a store, and there's a cash register full of cash in that store. And I'm standing outside the store. My life would be better if I had that cash. Well, you know what? First reason I won't do that is I'm a good person. That's just not me, so I'm not going to do that. Second reason is, well, there's laws around that. There's police and there's prison with consequences. So that's how society works. Most people don't walk into the store and take the money. But you put a gun in my hand and I have a sick kid at home, I'm going in the store and taking the money. So what you do is you take good people and you give them a weapon and you threaten the family. Now they're capable of going beyond what they would normally go beyond in order to keep their job. There's another example we have. We did 2 podcasts on our own podcast. I'll plug it right here. Bare Naked Money.
Yes.
We have our own podcast.
Sorry, I cut you off, Colin. What's it called? The podcast?
Bare Naked Money.
Oh, yes. Okay, good.
So we did 2 podcasts on the worst financial advice. So the whole team came forward with the worst financial advice stories that they've ever seen in their careers. Some of it was personal, some of it was, professional. But one of the story that actually did make the podcast, which I thought was a great podcast. He was a junior at a financial institution. It was around the time of COVID, so things were kind of locked down. So they were going to bring banking to the business. So they went out to one of their business clients to help them. And the senior guy who was going said, listen, everybody gets a TFSA. The junior said, okay, and TFSAs are great. I love TFSAs. Virtually everybody should know. But that's a bit of a bold statement to make. So he walked in and made a presentation to the group. And then they all sat down for individual meetings. Every individual meeting ended up with a TFSA. Regardless of what was said or what the conversation was, everybody got a TFSA. They went back to the branch, everybody was fine. But this was a graphic arts business that was actually working on video games. And everybody in that office was a U.S. citizen.
There you go.
So the junior notices this, and for the listeners, U.S. citizens should have a TFSA. The vast majority of cases, it's very pejorative. But the junior goes to the senior and says, hey, listen, we kind of screwed up. We have to go back. And the response was, well, no, my name's at the top of the list, because that was the current sales target they were headed for, was opening TFSAs. And his name was on top of the list. So he was just going to let it sit. So, the conflict is that piece of paper on the wall, and I don't know whether it was a free lunch or a Friday off or what the reward was, but again, it was just something that was being trapped. And this is an extreme example of how somebody reacted to that motivation, but take advantage of it. But it's a real-world example of how those conflicts manifest themselves in the industry. And your second question was the difference we've made. There's nobody in our group that works on commission. There's nobody in our group that has a sales target. We don't track any of that. So there's absolutely zero of that. When somebody sits down at their desk, there's a dashboard that says, here are the clients we haven't talked to. They'll be able to call a whole system for how that list gets populated. Their only job is to call these people, see if they're okay, see if we can help them. That's the only metric we track every Friday. Any client that's owed a phone call needs to have been called. That's the only metric that we control. So the person sitting across from a client is not incentivized to, their paycheck that week is not going to be different depending on the outcome. The paycheck that month is not going to be different based on the outcome of that meeting. So one product over another product doesn't matter. So we've taken that incentive. I think that's where the problem with the industry is. I'm running on a little bit here, but I'll give you one more little example.
Yeah, please keep going, Colin.
There was a serial fined and banned an advisor recently for one of the banks, and their crime was that they had gone into, and this is something, it's a public case that was out there, they had gone into client accounts and started packs into RSPs and TFSAs, and then stopped them before they ran. So they basically put a transaction on a client account to start and stop something. No money ever came with it. No money was ever missed. No client was hurt. But they were doing this in order to hit their sales target, because their sales target was to open a certain number of pre-authorized deposits to TFSAs. So the person gets found, they notice the activity, and they get fined, and they get banned from the industry. But the incentive's still there. They never address the fact that there's an incentive in the system that in the right circumstances is going to cause somebody to do this. And it's a slippery slope if you start going down the road of trying to ban those kinds of practices. But, the problem is, first, nobody lost a cent. No client was actually affected by this. But the industry is going to go, no, you're a bad person, you're out of the industry. Behavior was spawned out of that motivation. That was provided by an external source. Somebody put a gun in their hand to threaten their family, worker did what they needed to do.
This is, those unintended consequences. When you have very large distribution businesses, you come up with strategies to boost revenue in certain areas. Of course, implicit in that is, you expect people to behave properly. But when you've got thousands of people, all who can construe what you're asking for differently, you end up with some really bad behaviors, the way you're describing it. And Colin, as you and I think the way we both designed our firms, the best way to showcase a fiduciary standard is to actually eliminate the conflict so that you don't have to worry about the disclosure. You don't have to worry about the judgment call or the unintended consequence. Just eliminate it. And so in your scenario, when you pay people, absolutely your money where the mouth is, because, let's not kid ourselves, compensation will always drive behaviors. And so if you're saying we're paying you to do the right thing and that's how you get rewarded at the end of the year, people understand very clearly that's going to drive the behavior. They're going to do the right thing because there's no incentive to do anything but the right thing.
No, listen, absolutely. I guess the only challenge is sometimes untrained people who've been in the industry for a while. Because again, it creeps in. Like you think you're doing the right thing, but if you really examine it, if I challenge somebody, I have to go, oh wait, that is wrong. See? So it's not always malicious intent. Like, sometimes it's just unknowing or having been trained in a certain way, or it's just a lack of knowledge.
Yeah.
More so than being malicious.
Yeah. Let me, if you don't mind, pile on with one of my pet peeves in this area, which is...
Please do.
Which is insurance. In our business, planning is so important. And ultimately, there are many strategies related to insurance, which are very beneficial to the family. So I start there. However, there are incentives in many places, particularly, I think, places that actually have an insurance distributor, where there is a very strong incentive that the investment advisor or counselor could potentially make tens of thousands of dollars of additional compensation for introducing their friend next door who is the insurance person for a strategy that may be appropriate and all of that. And let's assume it is. The point being, as a true fiduciary, doing the planning, making the recommendation, if you have 100 clients, if I'm not saying you're going to make tens of thousands of dollars for doing the right thing, if I say you're going to make tens of thousands of dollars, what do? You prioritize your clients based on what? That insurance opportunity. And so who pays the price ultimately is the clients that do not present that insurance opportunity, who may not get the plan, who may not have the discussion. And it's back to my point of what I love about how you've designed your compensation, very similar to us, Colin, is a program that you would be proud to show your clients. How do I get paid? And I often say to many advisors, candidly, it's not their fault that the compensation program is built as it is. They didn't design it. But I doubt they're excited to pull it out and show their clients the 20-page document as to how they get paid.
Well, no, absolutely. And we try to do it here as well. I mean, again, this is something that goes on everywhere. So we had the gentleman sold his business. He pocketed $2.5 million, and he went to an advisor, and the advisor gave him a 100% insurance solution. Like the whole $2.5 million is going to go into an insurance concept. And he wasn't all that comfortable with it, so he sought second advisor walks in and gives him a bit more of a balanced approach to insurance, but also some investing. It says, okay, that's interesting. I want you to present to my accountant. So he sets up an appointment, presents to the accountant. And the accountant said the quiet part out loud, I don't get paid if he does this. I get paid if he does the insurance. So I'm going to recommend he does the insurance. Because accountants can be paid.
Yeah.
They can actually get paid for recommending it. Now, how well is it disclosed? Is it disclosed? Ask the follow-up question. But all of the most complicated insurance concepts out there are amazingly fragile. And again, having been at this so long, I've watched so many people. We have an 85-year-old client who we inherited, and she has an insurance policy that she's been paying into for over 40 years. And we're working with the insurance company because it's an increasing mortality. The premium has to keep increasing, even at this age, which is absolutely asinine. But it's hitting a point where the maximum premium allowed to be paid based on the tax limitations of putting money in policy will be exceeded in 2 years' time. Therefore, she will not be able to pay the premium if she has the money. So the insurance companies, if she lives 2 more years, is going to lapse the policy, and she gets nothing. And I'm going, how on God's green earth could somebody put something in place where this is an outcome? I love insurance. I've been licensed for insurance since '92. It's a very fundamental role in estate planning. Good, basic, fundamental insurance is absolutely invaluable in estate planning. Complicated or aggressive concept selling, where there's a whole bunch of commission to be made, is very damaging. We spend a lot of time on doing that. The average permanent insurance policy that's put in place, the first 2 years of premium are with it on average. Like that's a very normal thing. So if you're putting a $100,000 a year premium in place, you can do that. That's a lot of guns in hands. That's a lot of threatened families. That's a lot of motivation for somebody to consider rationalize doing something that's in their best interest.
Yeah, this is, I think we could keep going on compensation. Other conflicts that you are trying to confront. So we've talked about compensation. We've talked about product architecture and manufacturing.
Well, it's access to services, right? So, you get into some of the major institutions and they have, we have a whole team here. We have an insurance specialist. We have financial planning specialist. But each of those is a silo, and each one of those has their own metrics. So the insurance specialist, I know some, they have a minimum $100,000. Like they will not look at anything that's less than $100,000 premium. The insurance salesperson, they're not going to go in and do a needs analysis for somebody and actually solve an insurance problem. If they're brought in, the only meeting they will accept is one that they're going to walk in the room with an expectation of certain premium size. If you want to use the financial planner in institutions, it's not based on your assets, it's based on, is there a business case, as they say? What we're looking for is a sales opportunity. Like if we put the financial planner in the room, is she going to be able to position the sale of insurance? Or is he going to be able to position? Then we're going to put them in. Access to services is even influenced by this. And again, within our group, nobody owns a client, nobody owns a book, and he's being on grid. So, I took one of our new associates out to the prospect who was a business owner. We sat down and had a chat about their business structure and everything. It seems kind of messed up. We went back to the office, called our CPA and said, hey, Claudio, can you take a look at this? We set up an immediate meeting, had a conversation. Because Claudio's compensation is not tied to what happens in that phone call. That he doesn't have a horse in that fight. He's just a curious person who's well qualified, going, oh my God, this guy looks like he's in a mess. Let's help him see if we can figure it out. So we removed all of those barriers from availability of talent. That's another way that the conflict gets in the way of having the system function as maybe people want it to or think it does.
Fantastic. These are really, really great examples. It takes me to where we started around the RIA market relative to the independent ICPM market in Canada, where let's say there's under 400 independent investment counseling firms. We could debate the number, but around there's 18,000 firms, largely driven, as you've pointed out, through breakaways of brokers and wirehouses from the banks, etc. Your take on this, is this the way it's going to stay, a highly concentrated market? Do you think we will see more breakaways? And maybe underneath that, why? Why have the markets evolved so very differently?
Well, Sonny, I was out in San Francisco to a conference a couple months ago now. And it was fascinating. I'm sitting in the room and they start telling stories about the good old days. I was like, oh, tell me more about the good old days. Because I think we might be where they were 25 years ago.
Yes.
It's at least there's some similarities.
Yes.
But I do think that there's a few things that the U.S. culture in general is more of a risk. It's more of a dog-eat-dog world. It's very much more aggressive. They don't have the same oligarch. Well, I'm not sure if that's it. They don't have the same tightly controlled structure. And they don't have regulations that are skewed towards the fintech, financial technology available down there. Again, it's got a much bigger marketplace. They can have a much more fulsome offering. So some of the challenges we had getting established was setting ground systems. I both went through this. And it's dealing with 10 regulators, 10 provinces. The challenges we have here are way higher complications because some of the major wirehouses and brokers in the U.S. actually have turnkey solutions. So
yes,
it's not as much about setting up all your own things. So I think it's a combination of a society that's more risk-taking, an industry that's more diffuse, and the scale allows it to be a little bit more efficient than it is up here. I think it's a combination of all those things. In my conversation, I'm going to turn this one out on you. Why do you think it is?
Yeah,
you're not on my podcast right now, but I'm going to ask you the question.
That's great. I would echo certainly a lot of your comments, but I've spent a lot of time like you, Colin, in the US. I have a lot of friends that run RIA firms in the US. And there are a couple of other pieces. One of them is we never had what I would call the catalyst event. And for the US, the catalyst event, I mean, there were RIA for 25, 30 years, but the real catalyst event was the financial crisis in '08. And what triggered it was the fact that the banks had to restructure their businesses and fired a lot of brokers. And as a consequence of firing brokers, those brokers established RIAs and found themselves very successful. All of a sudden, the other brokers at banks and wirehouses look at this and say, wait a second. And to your point, the industry, someone said to me, it's like in the fifth inning, because an interesting stat of the US is, as you know, there's massive private equity players that are now consolidating all of these RIAs, and notwithstanding all that M&A activity, the net growth of RIAs continues to increase every month. So it does suggest that you still, like, this is not matured. You still are seeing the breakaways. And so the catalyst event, I think in Canada with the oligopoly, we have very well-run banks and they're highly concentrated. And so they have, let's call it 85% market share. But I do think we've a little bit lost the perspective of the fact that while banks are incredibly well run and stable and will be around a long time, they are not riskless. They lend money, they fund their lending by deposit gathering. At the core, that's what a bank does. And so to suggest that lending money is a riskless activity is just not the case. And my guess is at some point, and like you, I do not believe in market timing and predicting what's going to happen next month, because as we all watch CNBC, the answer is nobody knows what's going to happen next month. But having said that, if you talk to me about longer term and cycles, there will be a slowdown at one point. There will be a consumer slowdown at one point. There will be a challenge around the mortgage market at some point. And the banks have become increasingly concentrated, where now it's not like they have 60% share, they have 80 and 90% share. And so, ultimately, I think we are going to see a similar set of circumstances where the distractions of a portfolio will create more challenges for people operating as a fiduciary. I also would say that this is not for everybody. You mentioned it, Colin. The biggest difference, I interviewed somebody, Reuben Miller, who set up a RIA firm in the US. And I asked him how long it took for his registration. And he said 4 days. It took 4 days to secure.
No. And you're killing me.
As you and I both know, it is not, we have excellent regulators, but they're provincial. There's a lot of complexity, and it's a slow, time-consuming process that isn't for everybody.
No. It takes some perseverance to stick through. I'm sorry, you made me lose all train of thought now. Just
on the 4 days.
That's 4 days. Wow.
Because of course we don't have a category, right? There is no RIA category, and so we have to, set up a PM firm, which is another lift.
No, it is. And getting PMs registered is a big thing.
Correct.
We are largely a PM group. The regulator pushed back at us because we were putting in on our 10 or 15 applications all at once. Well, don't expect us just to approve all these. Like, well, no, we want you to do your job, but these people are, so, this sheer volume that we were putting through and registered was a challenge. I think the other observation I would make, I love this conversation, since because we are spark with trying to back flame.
Yes.
And you're right, the concentration has gotten worse in Canada on the bank side. And yet a lot of the other major independent firms that have formed that are not owned by distributors are being built to sell. Their pitch to advisors is, move your business to us. We're going to get a critical mass. Then we're going to sell to either a bank or private. It's the monetization. So there's very few out there that I've seen that are setting themselves up just to be, right? Like, we have Canada in our ownership group right now, and we're hoping to double that next year.
Terrific.
So we're trying to keep the control of the business within the business, because we're building something people really like. They like to be part of it. So, which again sets us apart, because I got a call, I don't know about you, my call came like 4 days after we actually launched noticeable private equity calling and going, hey,
yes, hey
fella, how you doing? Like, I'd like to talk numbers with you.
Yes.
It's like, really, this quick? I'm looking at my watch going, we were just born. Like, but okay, I'll listen.
Yeah.
But there's, and that motivates people. There are people out there, and there's a big number of kids thrown around. That's sharing that even there's sovereign wealth funds that are registering in the U.S. to come over and and participate in the RIA service in there. So yeah, the way I look at it, it's almost like a big bang. Like there's this gravity that sucks everything into a pile, does things badly, and lets it explode. And it sucks everything in, does it badly, and lets it explode. I mean, and I think that that's just an ongoing process in many businesses.
You also struck something here, which I think is really important to highlight, that the alternatives in Canada, if you're at a bank, a brokerage, as an example, moving to an independent brokerage, definitely there are advantages. You know, you have a more focused shareholder. It's one business as opposed to 30 businesses. But the part that I think is not well understood, and you just said it very well, is that is not the RIA model. That's the same model. That's the same traditional brokerage model of a commission grid, the same type of compensation structure. It's the same, team of teams working independently of one another. It's not RIA. What you've described during this conversation, this is most like, the RIA channel in the US with that fiduciary standard. And it is an area that we're working on messaging because, again, these are all great channels. There are phenomenal advisors within banks. There are phenomenal advisors at the traditional independent brokerage. There's phenomenal advisors in IC firms, but you should be educated on the difference between them. They are different.
No, absolutely. Listen, I say it over and over again. I've got super high quality people in all of these things. Yeah, but there is an experiment. You and I are both taking part in. There's a way to do this that is better, allows those people to do better work. But there are obstacles because we're out there looking for talent, for people to hire. Well, our competition are these other jobs.
Yes.
Yeah, so it's, we have to be competitive in compensation, even though we don't have the same sales culture. So we need to have a good culture there.
Yeah. And
there's lots of people that run away from us from the current model because they want to be hunters and killers and they want to have a $2 billion investment.
Yeah.
All that kind of thing.
Yeah.
So,
and to your point about learning, it's not for everybody. If you've grown up with one model for your entire 20-year career, this is a very different model. And so it won't be for everybody. But I think people should be aware of it. I had a conversation this week, as an aside, with a very good advisor at one of the banks. And he actually didn't even know the difference between an investment counseling firm and the independent brokerage firm. He thought they were kind of the same, i.e. they're not the bank. And, when we walk through those differences, and again, it's not good and evil. They're just very different operating models. There's a lot of work to do. I think to your point about trying to create a new category is the way I view the work you're doing and the work that I'm doing. I've really enjoyed this conversation. You've been very generous with your time. Before we close off, I have two questions. One, is there any topic area we didn't cover? And two, how do people get in touch and follow you? I know you're quite active in social, so what's the best way to follow Verican or you personally?
Hi, everyone, and thank you for this. I mean, you and I are coincidentally down the same road, and we met on this road. Mm-hmm. It was like we knew each other before this road, so it's, there's obviously some similarities here for sure. No, this topic is great. Like I said, I'm currently delivering a cross-Canada roadshow on this. But the best way is to stay in touch with us. I mean, Bare Naked Money is our podcast. There's episode goes out every couple of weeks, quite often. On there, there's well over 100 episodes out there. You can scroll through and find different topics. We just relaunched our website, verican.com. There's a lot of good videos and good information on there. It does a good job of curating all the content we're putting out because we put out every business day, there's a market that goes out from somebody on the team. So we have those kinds of things going on. But the website's probably the best way to follow us or to follow the podcast. The two easiest ways. We're very active on LinkedIn as well. So for those that want to follow us on LinkedIn.
Fantastic. Colin, I really enjoyed the conversation, really enjoy the work you're doing, and appreciate your time. So thanks, everybody, for joining us. We'll talk soon.